Okay, let's unpack this. The global economy is still navigating some genuinely choppy waters, right?
Yeah, definitely.
And that volatility ripples through even the biggest players. Today, we're diving deep into Halliburton's second quarter 2025 financial results. We've got their earnings call transcript, the official press release, quite a stack of material.
Right.
And our mission, like always, is to pull out the most important nuggets, the surprising facts. So by the end of this deep dive, you'll be quickly and thoroughly informed about this vital oil field services sector.
And what it means for energy overall.
Exactly. So against this backdrop, these choppy waters, how did Halliburton actually do? Did they manage? Okay, let's get straight into their Q2 numbers.
Well, the headline figures are actually quite striking. Net income came in at $472 million.
Okay.
That's 0.55 cents per diluted share, which is a pretty significant jump from Q1.
Big jump.
Q1 was $204 million. So yeah, nearly double the profitability quarter over quarter.
Wow, okay. And revenue.
Total revenue hit $5.5 billion. That's up 2% from Q1's $5.4 billion.
So growth there too.
Modest growth, yeah. Operating income was strong, $727 million, giving them a 13% margin.
Decent margin.
And cash flow looked good too, $896 million from operations and $582 million in free cash flow. Shows good discipline.
Right. Free cash flow is key.
Absolutely. And they topped it off by repurchasing about $250 million of their common stock.
Sending a signal to shareholders.
Exactly. Commitment to returning value.
So those numbers, especially that net income jump, they look pretty impressive on the surface. But given the choppy economy you mentioned, was this expected or did they just manage expectations well? What was that wider current they were swimming against?
Well, the CEO actually noted the oilfield services market felt very different compared to just 90 days before.
90 days, that's quick.
Yeah, really marked by increased volatility. And they pointed to specific drivers.
Like what?
Things like ongoing trade and tariff uncertainty, geopolitical unrest in various places, and the accelerated return of those OPEC plus production cuts, the coordinated supply reductions.
Right, pulling barrels off the market faster than maybe expected. And did they see immediate effects, like on the ground, different regions?
Oh, yeah. Immediate softness, particularly in North America.
Okay.
Multiple operators, even big established ones, are planning meaningful schedule gaps for the second half of 2025.
Schedule gaps, meaning downtime.
Basically pauses in drilling and completion work.
Yeah.
And internationally, similar story reductions in activity, lower discretionary spending.
Especially the big national oil companies.
Exactly, the NOCs, sort of mirroring what you'd see in much lower commodity price times.
Right.
They also mentioned those reorganizations and cost cuts we've seen from large independents and IOCs.
So this isn't just a minor tremor, it's a noticeable slowdown. What's the takeaway then? Is this a long-term structural issue or just a blip?
Well, the most crucial point from their CEO wasn't really about the immediate challenges. It was more a long-term vote of confidence. He said, quote, "Demand fundamentals remain strong for both oil and gas."
Okay, so underlying demand is still there.
That's the view. It signals they see this current softness as more of a temporary recalibration, not some fundamental market shift.
So they expect things to improve?
Yeah, the expectation is conditions will improve as that extra OPEC plus production gets absorbed and, operators have to replace declining production and meet growing demand eventually.
A temporary adjustment then. Okay. Given that expected softness, though, how's Halliburton positioning itself? What are their strategies, their growth engines?
Right. They're aligning with three key themes they think will define the next few years.
Okay, what are they?
First, unconventionals. Still critical for supply, and the demand for advanced tech to boost recovery is growing not just in the U.S., but globally.
Makes sense.
Second, production-related services, things like intervention, stimulation, artificial lift. They expect those to grow as global production increases overall.
Right, keeping existing wells flowing.
Exactly. And third, rising demand for complex drilling and well construction, stuff that needs advanced tools, automation for efficiency.
Okay, so it really does sound like they're leaning hard into technology and efficiency.
Very much so.
Halliburton clearly has this future strategy, but where does it actually, hit the ground? I'm keen to hear about the tech and the hotspots where they're putting this into action.
Absolutely. Let's look at international markets first.
Yeah.
Q2 revenue there was $3.3 billion.
Okay.
That was up 2% sequentially, driven by more activity in Latin America and Europe, Africa.
But there's always a but.
Yeah. Offset by reductions in Saudi Arabia and For the full year 2025, they actually expect international revenue to contract slightly, mid-single digits year on year.
Ah, okay. Mainly because of Saudi and Mexico?
Primarily, yeah. So it's a really complex global picture right now.
A mixed bag internationally, then. Were
Yeah.
there any specific bright spots? Where are they seeing real growth or tech adoption?
Definitely. They expect growth in places like Brazil, Norway, and these offshore frontier basins. And what's really interesting is seeing that North America-style development, multi-well pads, long laterals, big completions, really expanding internationally now.
Taking the shale playbook global.
Pretty much. Bringing those efficiencies elsewhere. We saw examples. Argentina hit a record quarterly stage count, did their first sensory fiber optic fracture monitoring.
Getting real-time data downhole.
Exactly. In Australia, they did a huge 67-stage stimulation job in the Bidley Basin.
Biggest one there.
Biggest to date, yeah.
Yeah.
And in the Middle East, they drilled the longest well in that region's largest unconventional play.
That's a serious transfer of expertise. What about drilling and production tech beyond just unconventionals? What other innovations are making a difference?
Yeah, big strides there too. In drilling, tech like iCruise, their smart rotary steerable system, Logix automation for closed-loop drilling.
Self-driving drill bit, almost.
Sort of, yeah. And the iStar platform for real-time placement. They've drilled over 500,000 feet globally now with Logix automation. And get this. In Norway, they use iCruise and Logix to drill the longest well ever on the Norwegian continental shelf, over 10 kilometers deep.
10 kilometers. Incredible.
And for reservoir mapping, they launched EarthStar 3DX. This is pretty groundbreaking. It gives a 3D map ahead of the drill bit while drilling.
So you can see where you're going.
Exactly. Proactive steering, precision placement, avoids costly mistakes.
Smart. What about production services?
They started their biggest integrated well intervention contract in Brazil, expanded riserless coil tubing in Norway that lets them work on wells without a big rig.
More efficient.
And an artificial lift that's crucial for getting oil and gas out. Halliburton landed its largest international ESP contract ever.
ESP, that's electric submersible pump.
Correct. From a major Middle East NOC. International artificial lift revenue is expected to grow over 20% this year.
20% growth, that's huge.
Yeah, and they plan to double the installed base of Intellivate, their remote ops and automation platform for lift.
So more automation there too.
Definitely. In fact, they expect their international artificial lift business to be bigger than the entire Summit company was when they bought it, just by year end.
That's a big milestone. Shows strong organic growth. Okay, let's shift back home. North America. What was the picture there in Q2?
North America revenue was $2.3 billion.
Yeah.
Pretty much flat compared to Q1.
Flat. Why?
Well, seasonal improvements in completions work got canceled out, unfortunately.
Why?
By lower service pricing, that's a big one, and also reduced artificial lift activity.
Okay, so pricing pressure is hitting them there. What's the outlook for the rest of the year in North America? And what are they doing about it?
They expect second half revenue to decline, lower drilling and completion activity.
How does that look on the ground?
They described it as more white space in the frac calendars.
Meaning idle equipment.
More idle time, yeah. Plus the full impact of those price cuts kicking in, and they'll be stacking frac fleets, taking them out of service if they don't meet profit thresholds.
Stacking fleets. Wow, so the full year forecast.
Full year North America revenue now forecast to decline by low double digits year over year.
Okay, that's a significant revision. Despite this, though, Halliburton keeps talking about differentiation. How are they pulling that off in such a tight market?
Technology. It really remains the key differentiator for them.
Examples.
Well, Chevron just announced hitting a milestone with Halliburton's Zeus IQ closed-loop fracturing system in the Rockies.
Right, more automation and fracking.
Yeah, and Halliburton expects maybe up to a third of their Zeus electric fleets will be running Zeus IQ by the end of the year.
That's a quick ramp up.
It is. And in drilling, even with rig counts down, iCruise and Logix automation are driving rapid growth in their U.S. land rotary steerable business. Double-digit revenue growth in North America drilling services overall.
So high-tech stuff is still in demand, even if overall activity slows.
Exactly. It delivers efficiency gains that operators really value right now.
So given this near-term softness, what are their specific operational plans? You mentioned stacking fleets.
Right. They've got clear plans. First, like you said, refuse work where the equipment doesn't earn economic returns, especially in North America frac fleets.
That takes discipline.
It does. They stress it's a strategic commitment, not just reacting. Second, they plan to cut costs variable and fix cash costs over the next few quarters to size the business appropriately.
Right sizing.
And finally, maintain that laser focus on free cash flow and returns. Be diligent stewards of capital. Don't chase volume, maximize value.
A very disciplined approach indeed. Let's break down the financials a bit deeper then. There are two main operating divisions, completion and production and drilling and evaluation. What do those segments tell us?
Okay, completion and production, C&P. That's everything to get oil and gas out once the well is drilled. Q2 revenue was $3.2 billion, up 2% sequentially.
Okay.
But operating income was down 3% to $513 million. That's a 16% margin.
Why the drop in income if revenue is up?
Mostly lower pricing for stimulation services back in U.S. land. That pricing pressure again.
Got it. And the outlook for C&P in Q3?
They see revenue decreasing sequentially, maybe 1% to 3%, and margins shrinking by about 1.5 to 2 percentage points.
Oh, why this?
Mainly that North America land pressure pumping softness continuing, fewer international completion tool deliveries, and less frac activity in Saudi. So, yeah, significant pressure there.
Okay, what about the other side? Drilling and evaluation, D&E. That's the drilling, mapping, evaluation part.
Right. D&E revenue in Q2 was $2.3 billion, also up 2% sequentially.
Okay.
Again, operating income decreased, this time 11% to $312 million. Margin was 13%.
Why the income drop there? Pricing too?
Actually, no. Revenue was up from higher drilling services globally. The income dip was more about timing the usual seasonal roll-off of software sales, plus higher startup and mobilization costs as they moved equipment around.
Ah, okay. So not performance-related. What's the Q3 outlook for D&E?
They also expect revenue to decline slightly, 1% to 3% sequentially, but margins are projected to improve significantly.
Improve. How much?
To 1.25 to 1.75 percentage points.
Why the bounce back?
They expect software sales to pick up again, better performance in global directional drilling, and those Q2 mobilization costs won't repeat. So, yeah, a rebound expected there.
All right. Then the earnings call opened up for analyst questions. This is often where you get the real color, peeling back the layers on strategy. What came out of those Q&A sessions?
Yep, a lot of good stuff. Really helps sharpen the focus on their strategy. First off, customer conversations and the 2026 outlook.
What's the vibe?
Customers are definitely cautious, conserving budget. 2026 plans are still pretty uncertain. Halliburton thinks activity might pick up earlier next year than Q3 or Q4.
So maybe first half 2026.
Possibly, but they don't see customers really doubling down on spending until the commodity price outlook gets stronger.
A bit of a wait and see from operators then. How will we know when the market's really bottomed out? What are the signs?
The key things they're watching are, when does demand start eating into that spare production capacity? And when do production rates really start declining in key areas?
Okay.
They pointed out that activity in North America and Mexico is already below levels needed just to maintain production.
So something has to give eventually.
That suggests an eventual recovery is basically necessary just to keep output steady.
That makes sense. Now, about that pricing discipline stacking frac fleets instead of working cheap, isn't there a risk they lose market share long term? Competitors might just take the work.
That's the classic question, right?
Yeah.
Halliburton seems pretty firm on their make-choice strategy. They will stack fleets rather than work at levels they see as uneconomic.
And their reasoning.
They stressed it's not just about short-term profit. It preserves the equipment less wear and tear and avoids potential HSE risks from pushing crews or gear too hard.
Health, safety, environment.
Right. And they said, look, this isn't new for us. We did this in the gas markets before. It's about maximizing value returns, even if it means letting some market share go temporarily.
Interesting. A very deliberate strategy.
Okay, shifting to growth, where are the big international opportunities they're chasing? That international unconventional opportunity is key. It's not just Argentina and Saudi anymore. I think UAE, North Africa, often driven by demand for natural gas.
Right.
They see double-digit growth in their frac business outside the U.S. and feel well-positioned, especially in the Middle East, for these plays. It's like Shale 2.0, but global.
And speaking of Saudi, that huge Jafurah gas project tender, what's their approach? Go big or stay disciplined?
For Jaffa, they said they have a very disciplined approach to bidding. Focus is squarely on returns, not just winning volume, even on massive competitive tenders like that.
Consistent with their overall message, does this discipline extend to their whole portfolio? Are they looking at selling off any less profitable bits?
Yeah, they mentioned portfolio pruning. It's ongoing. They invest where returns and growth look best, like those ESPs, the artificial lift tech.
Right.
And they take a hard look at parts of the business that aren't meeting expectations. It's dynamic management.
Okay. Back in North America, there was some talk about potential tax reforms, the big beautiful bill reference. Is that factoring into plans at all?
Not really, according to them. They don't see tax reform as a primary driver for the North America outlook. It's much more about customer budgets and commodity prices.
Market fundamentals rule. Got it.
And on cost structure, they're cutting variable costs as activity slows, obviously, but also looking for structural efficiencies, maybe in the 1% range over the next couple of quarters, just right-sizing.
Makes sense.
They also see the shift in Saudi towards LSTK contracts, long-term service deals as a positive. Over 20% of their international business is already structured that way, offering more predictable revenue.
Yeah, that predictability must be welcome right now. Okay, so summing up the near term, what's the specific outlook for Q4?
For Q4, they're expecting flattish revenue at best overall.
Flat is the new up, maybe?
Yeah, perhaps. C&P revenue likely down again because of that North America frac white space. But D&E margins should strengthen. Importantly, they expect C&P margins to stay above double digits.
Holding profitability, even with lower revenue, and their big Zeus electric frac fleet expansion, still going full speed.
The Zeus program is totally demand-driven. If the demand isn't there, they'll slow the build-out.
Sensible.
And that ties into CapEx. Capital expenditures are likely to be at the lower end of their projected range for 2025-2026. Financial prudence again.
Okay. What else stood out from the analyst Q&A? Any other nuggets?
Yeah, a few things. Artificial lift dynamics. International growth is really strong, driven by conventional wells needing lift, plus tech and automation. But U.S. land is getting hit by lower activity and also those tariffs.
Tariffs are impacting them there.
Significantly, yes.
Yeah.
It's a big part of their overall tariff impact. They're working on rewiring the supply chain to try and mitigate that.
Tricky. Any quick regional updates?
Kuwait looks solid, expecting growth.
Right.
Mexico's still seeing starts and stops, but they think the high decline rates there will eventually force more activity, given how crucial oil and gas is to the economy.
Okay. And what about the overall health of the industry's equipment? Are things getting worn out?
They expect industry fleet attrition to actually speed up.
Really?
Especially with gas fracking, which is harder on equipment. Higher pressures mean faster wear and tear. This could eventually tighten the market for good equipment.
Interesting dynamic. Lastly, the bottom line, free cash flow and shareholder returns.
Despite the headwinds, they revised their 2025 free cash flow outlook upwards slightly. Now $1.8 billion to $2.0 billion.
Still strong.
Very. And the commitment to their shareholder return framework is unchanged. They expect to be over their 50% return target by the second half of the year. Financial strength remains core.
So bring this all together. What we've really unpacked today is a company, Halliburton, navigating a genuinely volatile market, but with a very clear, very disciplined strategy.
Right.
Despite that short-term softness in North America, some international spots, they keep emphasizing the underlying strength of demand for oil and gas.
The long view.
Yeah, and their tech advantages, Zeus IQ, Earthstar 3DX, all that stuff seem absolutely key to their differentiation, plus that collaborative customer approach. And through it all, that unwavering focus on free cash flow, on returns, even when things get tough, it really is a story of strategic resilience, wouldn't you say?
I think so. And if we connect this to the bigger picture, what Halliburton's focus tells us, technology, efficiency, disciplined capital, says a lot about the future of the energy industry itself.
How so?
Well, it highlights this clear shift towards optimizing what we have with advanced tools, with automation, and a really selective approach to growth focused on returns, not just chasing volume.
Yeah.
It isn't just about oilfield services. It's about that innovative drive that keeps the lights on, keeps the world moving. So maybe something for you, the listener, to consider is this. In a world that needs energy, but also demands efficiency, maybe even sustainability, how might this tech-driven, value-focused approach reshape how we develop and deliver energy globally in the years ahead, beyond just these current market ups and downs?